The companies at the center of the AI boom have been busy investing billions of dollars in each other. I'm sure you've seen the spaghetti diagrams in the media recently showing how companies like OpenAI are investing in their chip suppliers, or how chip manufacturers like nvidia are investing in their customers, enabling them to buy more chips. I first noticed how strange these deals were back in March, when CoreWeave, a company who buys chips from nvidia, puts them in data centers, and rents out compute, filed to go public. Its IPO prospectus revealed that nvidia owned about 5% of the company. When investor interest seemed tepid after a long IPO drought, nvidia offered to anchor the deal at $40 a share with a $250 million order. That, roughly speaking, is the current state of AI infrastructure financing. While the sheer number and size of these deals have convinced some investors that the AI value chain is developing rapidly, others are concerned by the circularity. Two companies sit near the center of nearly every diagram: OpenAI and nvidia. Each is likely trying to ensure that everyone in the ecosystem, from suppliers to customers to cloud providers, has a vested interest in their success. OpenAI recently announced a $300 billion cloud infrastructure agreement with Oracle, a $10 billion custom chip partnership with Broadcom, and strategic alliances with major memory suppliers. According to UBS analysts, OpenAI's memory commitments alone account for half of the world's current capacity. nvidia, meanwhile, pledged up to $100 billion in investment to OpenAI, who will in turn buy millions of nvidia's AI graphics cards. AMD is also in on the game. OpenAI agreed to buy tens of billions of dollars worth of AMD chips, and in return, AMD gave OpenAI the right to buy 10% of its stock for 1 cent per share, contingent on AMD hitting certain share price targets and OpenAI deploying its chips. The way Matt Levine explained the deal at the time was that if OpenAI announces a big partnership with a public company, that company's stock price goes up. So OpenAI could just pay for the chips in cash, receive stock, and when the deal is announced, the stock would rocket, effectively reimbursing OpenAI for its purchase. Everyone wins. Amazon has its own version of the loop. It invested more than $8 billion in Anthropic, the company behind the Claude chatbot, and in return, Anthropic committed to using Amazon as its primary cloud provider. That means training and running its models on Amazon's custom AI chips, renting compute from AWS, and integrating Claude into Amazon Bedrock, the company's enterprise AI platform. In effect, Amazon is funding a company that will use its chips, run on its cloud, and help sell its services. And now, Google is getting in the loop too. Anthropic just announced a deal to access up to 1 million of Google's TPUs, bringing over a gigawatt of compute capacity online by 2026. The arrangement is worth tens of billions of dollars and positions Google as both a major investor and infrastructure provider. Anthropic says it chose Google's chips for their efficiency and performance, but the deal also reduces its reliance on nvidia and Amazon. Google has already invested $3 billion in Anthropic. Amazon has pledged $8 billion. Both companies now provide cloud services, custom chips, and strategic capital. Anthropic insists that it's just pursuing a multi-cloud strategy, but it's hard to ignore how deeply entangled it has become with all three of the largest US cloud providers, each of whom now has a financial interest in its success. Then there's Elon Musk, who seems to believe that the best way to build artificial general intelligence is to have his companies date each other. His AI startup, xAI, acquired Twitter, or the Everything app, which supplies real-time data to Grok, his chatbot, sometimes referred to as Mecha Hitler. Tesla, his electric car company, uses the chatbot in its cars and possibly its robots, which are coming next year. Musk owns a majority stake in xAI, which recently bought Twitter from him. He owns a minority stake in Tesla and now wants Tesla shareholders to invest in XAI. It's not incestuous exactly, but we'd have to get Elon Musk to explain why it's okay. The whole thing is starting to look less like a tech boom and more like a Mobius strip made of venture capital and electricity. And the electricity part isn't a metaphor either. McKinsey forecasts $5.2 trillion in capex for chips, data centers, and energy over the next 5 years alone. Bain says that we'll need to see $2 trillion in annual revenue from AI companies just to justify that spending. OpenAI has about $13 billion in revenues today and is essentially a money furnace. Anthropic is a smaller money furnace. Nvidia is very profitable, but not $100 billion profitable. So the question becomes, who's going to pay for all of this? The interconnected nature of these deals, the reason we need spaghetti diagrams to understand them, has raised concerns about circular financing. Companies are investing in each other, buying each other's products, and pushing up each other's stock prices. Investors are now asking whether these interdependencies could pose risks if AI demand or monetization falls short of investor expectations. The AI industry's investment structure is starting to resemble something we've seen before, just not in Silicon Valley. In post-war Japan, large industrial groups known as keiretsu were built, usually around banks and trading houses, with companies taking stakes in each other and coordinating supply chains. South Korea's chaebol system followed a similar pattern, but with families in control rather than banks. These models weren't about competition. They were, at least initially, about survival in capital-constrained economies. It seemed to make sense to have tight financial relationships with the businesses you relied upon so that your supply chains were secure. The keiretsu and chaebol models were often criticized for obscuring financial risk, misallocating capital, and propping up uncompetitive firms. When Japan's asset bubble burst in the 1990s, the tangled web of cross-holdings made it almost impossible to unwind bad bets. Today's AI giants are by no means short on capital, but they are assembling these webs of mutual dependence. The question is whether today's AI giants are building a similarly fragile structure which looks stable from the outside but depends on a constant influx of new capital to keep the lights on. When we look at the numbers, they almost seem made up. OpenAI's Stargate project, announced this January at a White House event, is a $500 billion plan to build 10 gigawatts of AI data center capacity across the US. It's firstly kind of crazy that we're talking about data centers in terms of gigawatts. According to the US Department of Energy website, a typical nuclear power plant produces 1 gigawatt of power on average, and that's enough electricity to power 1 million typical US households. The typical US household is 2.6 people, so 10 gigawatts is enough power for 26 million average Americans. OpenAI isn't just building Stargate. The Financial Times pointed out that the 6 gigawatt deal announced with AMD is enough energy to power Singapore for a year. But there are other deals too. All in, OpenAI has committed to building 23 gigawatts of new data center capacity, which they say will cost well over $1 trillion to develop, and it seems would require 23 nuclear power stations to power up. In Texas, where several Stargate sites are planned, electricity demand is rising so quickly that some operators are installing on-site gas turbines and exploring nuclear partnerships to avoid waiting for grid hookups. The XAI data center in South Memphis is running gas turbines with no emissions controls and no permits, creating enough pollution that, according to Politico, the area surrounding it leads Tennessee in asthma hospitalizations. There's not just one or two of these firms. All of the big tech firms in the United States and a bunch of additional firms in China and elsewhere are building out AI capability. So, As I mentioned earlier, McKinsey now estimates that $5.2 trillion in capex will be needed by 2030 just to build the data centers required for the projected AI workloads. On top of that, data centers powering traditional IT applications are expected to require $1.5 trillion in capital expenditures, meaning that we're talking about almost $7 trillion in projected data center spending over the next 5 years.